Hi there, it's Friday the 23rd of November 2018. I'm Steve Towers. Welcome to ITB. Let's get started. Let's start with the EU's proposed digital services tax. It looks increasingly likely that the projected start date for the DST will be the 1st of January 2021, not the 1st of January 2020 as in the original proposal. It's been reported that for the upcoming ECOFIN meeting on the 4th of December, Austria, in the EU presidency seat, will present 3 implementation options, all with a 1st of January 2021 start date. The 3 options differ in regard to the relationship with any emerging global solution. A possible global solution which is currently receiving attention is called GLOBE. This is the Global Minimum Tax Proposal, which is being advocated by Germany and France. You'll remember that this is the third of the 3 ideas or solutions which were identified by Pascal Saint-Amand in the OECD's October Tax Talks webcast. GLOBE is an acronym for Global Anti-Base Erosion. According to reports, GLOBE will have at least 2 aspects. An income inclusion rule for CFCs, which would be similar to the US GILTI regime, and an outbound payments rule, which would allow market countries to deny deductions for outbound related party base erosion payments, such as interest and royalties, regardless of the fact that the payments might comply with the arm's length principle. GLOBE and the other 2 ideas or solutions focus on data and user participation and a broad-based expansion of market countries' tax rights will be discussed by the Task Force on the Digital Economy at its upcoming meeting on the 4th and 5th of December. The OECD has released guidance for countries to prepare MLI synthesized texts covering their double tax treaties. The guidance runs to 99 pages and includes a full MLI synthesized text for the 2014 OECD Model Treaty. Now, I can hear you asking the question, why not the latest, the 2017 OECD Model Treaty? The answer is that the 2017 version already includes all of the MLI provisions. An important distinction which needs to be drawn is between synthesized texts and consolidated texts. The guidance says this in regard to synthesized texts. Synthesized text would take the form of a single document or web page. It would reproduce A, the text of each covered tax agreement, including the text of any amending protocols or similar instruments, and B, the provisions of the MLI that will modify the effect of that covered tax agreement in the light of the interaction of the MLI positions the parties have taken. Synthesized text would also include explanatory information, including information on the entry into effect of the relevant provisions of the MLI. Synthesized text would thereby make it simpler to understand the effects of the MLI and the way it modifies the effect of each covered tax agreement. So, the synthesized text is a single document or web page which contains both the covered tax agreement and the particular MLI provisions which are operative based on the respective positions the parties have taken. In contrast, the guidance says this in regard to consolidated texts. Some parties, however, may prefer to produce documents that reflect MLI modifications as if these modifications would have been made through an amending protocol. While such a consolidated text may be easier to read than a synthesized text, producing consolidated texts could be challenging and the result could be confusing. The MLI does not amend the text of covered tax agreements. Instead, it applies alongside and modifies the application of the provisions of covered tax agreements. It is expected that many parties will prepare synthesized texts, not consolidated texts. Let me quickly run through some of the other important points made in the guidance. The parties to a covered tax agreement have no legal obligation under the MLI to develop synthesized texts. They are also under no legal obligation to consult each other in developing synthesized texts. However, the guidance encourages such consultation. There is no official format to develop synthesized texts, although the OECD expects that many parties will develop synthesized texts based on this guidance. Synthesized texts would ideally be prepared when the parties to each covered tax agreement have submitted a definitive version of their MLI positions. However, the effects of the MLI on the application of a covered tax agreement can change over time, as the MLI is a living instrument and parties can partially modify their MLI positions in the future. For a copy of the OECD's guidance, please go to our website or app. Let's now talk about the entry into force and the entry into effect of the MLI in regard to specific jurisdictions. According to the OECD, 15 jurisdictions deposited their instrument of ratification on or before the 30th of September 2018. That means that for each of those 15 jurisdictions, the MLI has or will enter into force on or before the 1st of January 2019. That's the effect of Article 34.2 of the MLI. It also means that for each covered tax agreement between those 15 jurisdictions, the OECD says that there are 47 such agreements, the MLI will enter into effect for withholding tax purposes in regard to payments made on or after the 1st of January 2019. That's the effect of Article 35(1)(a) of the MLI. If all of this sounds a bit familiar, it's because I took you through these two provisions in ITB on the 28th of September. Well, the OECD has now issued a technical note which confirms what I told you in September. The particular point which the technical note analyses is the meaning of the phrase on or after the first day of the next calendar year that begins on or after the 1st of January 2019, as used in Article 35(1)(a) of the MLI. For a copy of the OECD's technical note, please go to our website or app. Well, this was a surprise. The Inclusive Framework on BEPS has issued a report which describes its decision to expand its Action 5 focus on preferential tax regimes to tax havens, which it calls no or only nominal tax jurisdictions. It has decided to do so in order to ensure a level playing field between, on the one hand, jurisdictions with preferential tax regimes, which are required to satisfy the substantial activity condition in BEPS Action 5, and on the other, no or only nominal tax jurisdictions. The report says this: Action 5's focus on preferential tax regimes leaves the inclusive framework in a situation where, in elevating the substantial activities criteria for preferential regimes only, it has created a perceived level playing field issue. The specific concern that has been raised is that business could simply relocate to a no or only nominal tax jurisdiction to avoid having to meet the substance requirements that apply to preferential tax regimes. For example, some inclusive framework members which have a corporate income tax system offer international business company regimes, and these jurisdictions have been assessed and committed to amend or abolish the regimes. If the regime is being amended, this includes the addition of substantial activities requirements. At the same time, similar international business company laws apply in no or only nominal tax jurisdictions. But based on the current application of the criteria, the inclusive framework would not ask for the same amendments or abolition of the corresponding legislation. It has been argued that this may even increase the pressure on taxing jurisdictions with low rates of corporate income tax to consider abolishing them, possibly triggering a race to the bottom that the Forum on Harmful Tax Practices was created to address. And so the report describes a plan to apply the same or similar substantial activities conditions to no or only nominal tax jurisdictions, as currently applied to jurisdictions with preferential tax regimes. Let me briefly outline those conditions, and then I'll talk about sanctions. So let's start with the conditions. Just like the previous work on Action 5, the report distinguishes between non-IP income and IP income. For non-IP income, the no or only nominal tax jurisdiction will be required to define the core income generating activities for each relevant business sector, ensure that core income generating activities relevant to the type of activity are undertaken by the entity or are undertaken in the jurisdiction, require the entity to have an adequate number of full-time employees with necessary qualifications and incurring an adequate amount of operating expenditures to undertake such activities, and have a transparent mechanism to ensure compliance and provide an effective enforcement mechanism. As with the review of preferential tax regimes, there will be special dispensations given to pure equity holding companies and shipping companies. In regard to IP income, the substantial activity condition in regard to patents and similar assets will be effectively the same as for preferential tax regimes, compliance with the nexus approach. The report says this: the core income generating activities in this context would be conducting research and development rather than simply acquiring or outsourcing it, which reflects the same concept as the nexus approach. In regard to marketing intangibles, the report describes the necessity of departing from the approach taken with preferential tax regimes. An adjustment would be needed from the nexus approach where an entity is exploiting marketing IP assets such as trademarks. The nexus approach provides that this type of IP asset is not permitted to benefit from a preferential regime, given that the policy rationale of an IP regime is to encourage and reward scientific innovation rather than marketing activity, with the consequence that a taxpayer engaged in exploiting marketing intangibles is required to pay tax at the ordinary rate. However, in the context of a no or only nominal tax jurisdiction, there is no or no significant ordinary tax to apply. An analogous approach would be to apply a similar substantial activities principle as set out earlier in the report, where the core income generating activities are branding, marketing, and distribution. Now let me talk about sanctions for non-compliance. The report says this: there should be a mechanism to take action in the event an entity failed to meet the substantial activities requirements. Given that there is no ability to apply a higher rate of tax, as would be the case in the context of a preferential regime, there should be a sanction mechanism that is rigorous, effective, and dissuasive. The determination of whether a sanction mechanism is rigorous, effective, and dissuasive will depend on the context. If relevant and appropriate, such a mechanism would include striking an entity off the register where this is an effective sanction. The no or only nominal tax jurisdiction would also need to continue enforcement efforts and remedy any shortcomings in the enforcement process. The report doesn't refer to any sanctions against a no or only nominal tax jurisdiction which does not implement such a system. However, being labelled a non-cooperative jurisdiction by the Inclusive Framework or the G20 or the EU will likely lead to some negative consequences in due course. Let me put this report in context. Take a typical tax haven, for example, the Cayman Islands, which has no income tax. The Cayman Islands has been a popular location to form companies which own various types of assets, both IP and non-IP. If the Inclusive Frameworks plan is implemented, the Cayman Islands government would be expected to deny the use of a Cayman Islands company which does not satisfy the substantial activities condition. For example, if the Cayman Islands company owns and exploits a patent, it must satisfy the nexus approach in regard to the related R&D. If the company fails that condition, the Cayman Islands government would be expected to strike that company off the corporate register. To my mind, that sounds like an extraordinary encroachment on sovereignty. And is it necessary? If all of the DEMPI functions in regard to the IP income are performed in countries outside the Cayman Islands, and the Cayman Islands company is the mere legal owner of the IP, then the 2017 OECD transfer pricing guidelines would require that all of the IP income, other than possibly the risk-free rate of return on capital, is reported for tax purposes in those other countries. The final comment I would make is that if this plan is implemented, the concept of no or only nominal tax jurisdiction should not be limited to poor Caribbean islands. It should also extend to Delaware and other US states without an income tax in regard to hybrid entities such as LLCs. Otherwise, there really won't be a level playing field. For a copy of the Inclusive Frameworks report, please go to our website or app. I have two other OECD developments to mention concerning BEPS Actions 5 and 14. In regard to BEPS Action 5, the OECD has released the latest results on the review of preferential tax regimes, including a consolidated update of all regimes which have been considered since the start of the program or are currently being considered. In that latter category, currently being considered, is the US FDII regime. For a copy of these results, please go to our website or app. And in regard to BEPS Action 14, the OECD has launched the 7th batch of peer reviews in regard to the dispute resolution process. There are 8 jurisdictions which will be reviewed in this batch: Brazil, Bulgaria, China, Hong Kong, Indonesia, Papua New Guinea, Russia and Saudi Arabia. As usual, the OECD has invited taxpayers to provide input via a questionnaire. For a copy of the questionnaire, please go to our website or app. The UK Court of Appeal has provided us with the latest instalment in Fowler's case, which I've been following for a number of years. This case concerns the impact on a double tax treaty of a domestic law income characterisation rule. Let me remind you of the facts. The taxpayer is an individual and is resident in South Africa. He is a professional diver. For part of the year, he works on offshore oil platforms in the UK. He performs that work under an employment contract with a UK company and, of course, is paid a salary. Article 14 of the South Africa-UK Treaty corresponds to Article 15 of the OECD Model Treaty. Article 14.1 says this: subject to the provisions of Articles 15, 17 and 18 of this Convention, salaries, wages and other similar remuneration derived by a resident of a contracting state in respect of an employment shall be taxable only in that state unless the employment is exercised in the other contracting state. If the employment is so exercised, such remuneration as is derived therefrom may be taxed in that other state. Based on the facts I have described, Article 14.1 would allow the taxpayer's salary to be taxed in the UK for the simple reason that his employment with the UK company is exercised only in the UK. But note the highlighted words: salaries, wages and other similar remuneration derived in respect of an employment. None of those words is defined in the treaty, but the treaty does contain Article 3.2. As regards the application of this convention at any time by a contracting state, any term not defined therein shall, unless the context otherwise requires, have the meaning that it has at that time under the law of that state for the purposes of the taxes to which this convention applies. Any meaning under the applicable tax laws of that state prevailing over a meaning given to the term under other laws of that state. In this case, it is the UK which would be applying the treaty. And so Article 3.2 says that in regard to the undefined terms in the treaty, the UK domestic law meanings of those terms, if such meanings exist, are required to be used, subject to the various conditions which are included in Article 3.2. Well, the taxpayer argued that those undefined terms in Article 14.1 do have UK domestic law meanings, and thus those domestic law meanings should be used in accordance with Article 3.2. The UK domestic tax law treats divers who are in fact employed in an unusual way. The relevant provision is Section 15.2. The performance of the duties of employment is instead treated for income tax purposes as the carrying on of a trade in the United Kingdom. There are 2 points which should be noted with this provision, Section 15.2. Firstly, and obviously, the diver is treated for UK income tax purposes to be carrying on a trade in the UK. And secondly, that treatment is instead of the actual employment. In other words, the diver is treated as not carrying on the duties of employment. And so the taxpayer's argument was essentially this. Section 15.2 deems the taxpayer to be carrying on a trade. Therefore, the business profits article in the South Africa-UK Treaty, Article 7, applies to the taxpayer. The UK tax authorities accepted that the taxpayer did not have a PE in the UK under the definition of PE in Article 5 of the treaty. Accordingly, Article 7.1 would provide an exemption from UK income tax. And Article 14.1 does not apply because Section 15.2 of the UK domestic law says that the taxpayer is treated as not carrying on the duties of employment. That last point about Article 14.1 not applying is very important. From the taxpayer's viewpoint, it would not be sufficient to merely establish that Article 7.1 applies to provide an exemption. And that's because Article 7 always allows a specific provision, like Article 14, to have priority. Article 7.6 of the treaty says this: where profits include items of income or capital which are dealt with separately in other articles of this convention, then the provisions of those articles shall not be affected by the provisions of this article. So for that reason, the taxpayer had to establish that Article 14.1 does not apply. The Court of Appeal, by a 2-to-1 majority, decided the case in the taxpayer's favour. Both judges in the majority emphasised that the result follows directly from the deeming effect of Section 15.2. Lord Justice Henderson said this: the words "for income tax purposes" in Section 15.2 are clearly wide enough to embrace the purposes of double taxation arrangements given effect in domestic law. Under the treaty, the article which applies to the taxation of business profits is Article 7. I can see no reason why the wording of that article should not apply to the profits of the deemed trade carried on by Mr. Fowler. The fact that it was a deemed trade cannot matter, because in the deemed world introduced by Section 15.2, Mr. Fowler was clearly carrying on a business, and thus an enterprise of a contracting state within the meaning of Article 7.1. Nor can it be argued that the application of Article 7 is displaced by Article 14, because in the deemed world, Mr. Fowler was not in receipt of any salaries, wages, and other similar remuneration derived in respect of an employment. Interestingly, Lord Justice Henderson had this to say in regard to Article 3.2. My approach does not depend to any significant extent on the provisions of Article 3.2, upon which counsel for the taxpayer place considerable reliance. In broad terms, however, I would accept his submission that the purpose of Article 3.2 is to anchor the provisions of the treaty, based as they are on the OECD model, to the domestic tax law of the contracting state which is applying the treaty. The other judge in the majority, Lord Justice Baker, said this: Article 7 of the Double Taxation Treaty between the UK and South Africa applies to business profits, whereas Article 14 applies to income from employment. Article 7.6 provides that specific items of income which are dealt with separately in other articles of the treaty fall outside the provisions of Article 7. This means that where Article 14 applies, Article 7 does not. The term employment is not defined in the treaty, and under Article 3.2 is ascribed the meaning that it has under UK tax law. Under that law, in respect of his seabed diving activities as defined in Section 15, Mr. Fowler is deemed not to be in employment, but rather carrying on a trade. Insofar as his income falls within Section 15, it follows that it is not remuneration in respect of an employment under UK law, and as a result, Article 14 of the treaty does not apply. Mr. Fowler's income from his seabed diving activities therefore falls within Article 7. And so both judges in the majority held that the deeming effect of Section 15.2 under the UK domestic law is to change the character of the taxpayer's income from employment income to trading income. And that change in characterisation is also applicable to the treaty. For a copy of this decision, please go to our website or app. And speaking of characterisation of income, in Australia, the tax authorities have issued guidance in regard to mischaracterisation of income. The guidance focuses on arrangements where the outbound payments from Australia understate the amount of royalties, which therefore causes an underreporting of royalty withholding tax. The guidance gives two examples. Let me take you through the first one. An Australian company, Ozco, is party to an agreement with a foreign company, Forco. The terms of the agreement provide that Ozco will acquire from Forco the right to manufacture, market and distribute certain products in Australia, manufacturing know-how, including secret formulas and processes, a right to use trademarks, and goods such as raw materials used in the manufacturing process. The terms of the agreement provide that Ozco will pay a single undivided amount of consideration to Forco, and this amount is stated to be solely for the purchase of the goods. Ozco and Forco don't recognise any part of the amount paid by Ozco to Forco as being consideration for Ozco's use of Forco's trademarks and manufacturing know-how. Accordingly, the parties don't recognise any part of the amount paid by Ozco to Forco as a royalty. According to the guidance, we are currently reviewing these arrangements and engaging with taxpayers who have entered into or are currently considering entering into these arrangements. Compliance activity and engagement will continue as we develop our technical position on these arrangements. For a copy of the guidance, please go to our website or app. Also in Australia, the tax authorities have issued a new draft schedule to their existing guidance on offshore hubs. The new draft schedule concerns offshore shipping service hubs. For a copy of the new draft schedule, please go to our website or app. And speaking of offshore hubs, the Australian tax authorities have announced a settlement with BHP Billiton in regard to a major tax dispute concerning its marketing hub in Singapore. For a copy of the announcement by the tax authorities and a copy of BHP's press release, please go to our website or app. And finally in Australia, the High Court has decided a case in regard to goods stolen from a bonded customs warehouse. The court held that penalties are not limited to the holder of the warehouse licence. Penalties can also apply to the licence holder's directors, shareholders, employees or officers who have the necessary degree of power or authority to direct the warehouse's operations. For a copy of this decision, please go to our website or app. In Papua New Guinea, the government has presented its 2019 budget. there's only one definitive tax change which caught my eye. The tax loss carry-forward periods for companies will be reduced. For resource and primary sector companies, the currently unlimited carry-forward period will be capped at 20 years. And for other companies, the current 20-year carry-forward period will be reduced to 7 years. Now, I said definitive tax change because the government is considering a list of other possible changes. New items identified in this budget include a capital gains tax, a minimum tax of 2% of revenue for loss-making companies, and a mobile telecommunications tax. And in Taiwan, the government has issued guidance in regard to the income tax liabilities for suppliers of certain inbound digital services. For a copy of the guidance, please go to our website or app. In Belgium, the tax authorities have released for public consultation a draft circular on transfer pricing. As you would expect, the draft circular is aligned with the 2017 OECD transfer pricing guidelines. Public comments are requested by the 12th of December. For a copy of the draft circular, please go to our website or app. The European General Court has decided a state aid case in regard to the Spanish tax scheme for the amortization of financial goodwill. That scheme is described by the General Court in this way. Under Spanish tax law, the amortization of goodwill for tax purposes is possible only in business combinations. However, pursuant to a tax measure inserted in 2001 in the Spanish law on corporation tax, where an undertaking liable for that tax acquires a shareholding in a company which is not tax resident in that state, and that shareholding is at least 5% and is held without interruption for at least 1 year, the resulting financial goodwill may be deducted in the form of an amortization from the basis of assessment for the corporation tax payable by that undertaking. The financial goodwill is equivalent to the goodwill which would have been recorded in the accounts of the acquiring undertaking were the two undertakings to be combined. You'll notice the highlighted words indicate that the shareholding which is acquired must be in a non-resident company. An acquisition of a similar shareholding in a Spanish resident company does not give rise to the goodwill amortization. It's that element of the rules which was argued to cause the amortization to be state aid, because it is thereby selective in nature. In other words, even though the amortization is available to all companies, all you have to do is acquire a shareholding of at least 5% in a non-resident company and hold it for 1 year, it is argued to be selective because it's only those companies which actually do make such an acquisition which are entitled to the amortization. And the General Court agreed with that argument, relying upon views earlier expressed by the European Court of Justice. The General Court said this: the General Court concludes that the measure at issue is selective even though the advantage which it provides for is accessible to all undertakings liable for corporation tax in Spain. According to the European Court of Justice, a measure may be selective even where the resulting difference in treatment is based on the distinction between undertakings which choose to perform certain transactions and other undertakings which choose not to perform them, and not on the distinction between the undertakings from the perspective of their specific characteristics. For a copy of the summary issued by the General Court, please go to our website or app. In Finland, the government has issued for public consultation 2 proposals which will amend the tax law in regard to investment funds. If adopted, both proposals would be effective the 1st of March 2019. If you'd like to make a comment on these proposals, you'd better get moving. The consultation period expires this coming Monday. For the link to the consultation website, please go to our website or app. In Germany, the lower house of parliament, the Bundestag, has passed amending tax legislation which covers a number of topics. 2 of those topics are particularly interesting. Firstly, the change of ownership rules, which apply to corporate loss attributes, will be changed back to their original form, with retrospective effect from the 1st of January 2008. This means that the rules apply only if there is an ownership change of more than 50%. The partial forfeiture rule for ownership changes in the 25% to 50% band will be removed. Also, the so-called restructuring exception is reinstated. The bill also contains the rules for the secondary VAT liability for online marketplace operators. These rules will apply from the 1st of March 2019 with respect to non-EU vendors and from the 1st of October 2019 with respect to EU vendors. In Ireland, the government has launched a public consultation in regard to the hybrid and interest limitation rules contained in ATAD 1 and 2. The consultation period ends on the 18th of January. For a copy of the consultation document, please go to our website or app. In Italy, the standoff between the Italian government and the European Commission has not yet been resolved. You'll remember that in October, Italy's draft 2019 budget was criticised by the Commission on the basis that instead of a structural improvement of 0.6% of GDP, it shows a worsening in the structural balance of 0.8% of GDP. The Commission requested Italy to present a revised draft budget as soon as possible, and in any event, within 3 weeks. Well, Italy has refused to do so. This has caused the European Commission to threaten financial sanctions, called the Excessive Deficit Procedure, EDP. The EDP has never been used before. It allows a fine of 0.2% of GDP. Who's going to blink first? In the Netherlands, the Tax Plan 2019 has been adopted by the lower house of parliament. The most contentious issue was the definition of a low-tax jurisdiction. This is relevant under the CFC rules and also under the proposed conditional withholding tax on interest and royalties to be effective in 2021. The government originally intended that a 7% statutory corporate income tax rate be used for this purpose. However, under significant pressure in Parliament, the rate was ultimately changed to 9%. And now to Romania, which has been requested by the European Commission to abolish its VAT split payment system. According to the Commission, the system is not in accordance with the EU VAT directive, and it creates significant administrative costs. In Spain, the saga concerning the mortgage documentation tax has possibly now been completed. In the last ITB, I told you that the government planned to change the law to overcome the effect of the decision by the plenary session of the Supreme Court to allow the banks to pass on the tax to the borrowers. Well, that has now happened. A royal decree which states that the banks are required to pay the tax has now been gazetted. For a copy of the decree, please go to our website or app. In Switzerland, the federal tax authorities have announced changes to their practices concerning tax rulings for Swiss principal companies and Swiss finance branches. No new rulings will be granted on or after the 1st of January 2019 for Swiss principal companies, which are governed by Circular Letter Number 8, and for Swiss finance branches. These changes are to align the ruling practices with the changes proposed in the Swiss corporate tax reform legislation, which is known as TRAF. For a copy of the announcement by the tax authorities, please go to our website or app. In Egypt, the government has issued the final version of the country's transfer pricing guidelines, which are closely modelled on the OECD's 2017 guidelines. You'll remember that Egypt originally issued its guidelines in draft form for public consultation. I covered this point in ITB on the 21st of September. For a copy of the final guidelines, please go to our website or app. Also in Egypt, the government has issued guidance in regard to the implementation of the VAT electronic filing system. For a copy of the guidance, please go to our website or app. In South Africa, you'll remember that the standard VAT rate was increased from 14% to 15% effective the 1st of April 2018. Well, the Finance Committee of the South African Parliament has now announced that it has reluctantly accepted this 1 percentage point increase. For a copy of the committee's announcement, please go to our website or app. And also in South Africa, the tax authorities have issued guidance on the valuation of assets for capital gains tax purposes. For a copy of the guidance, please go to our website or app. In Armenia, the government has fine-tuned its proposed individual and corporate tax law amendments. You'll remember that I covered an earlier proposal in ITB on the 21st of September. In this most recent proposal, the corporate income tax rate will be reduced from 20% to 18% effective the 1st of January 2020. And the dividend withholding tax rate will be reduced from 10% to 5%. For a copy of the government's proposal, please go to our website or app. In Saudi Arabia, the tax authorities have released the English language version of their general VAT guide, which was originally published in Arabic in October. You'll remember that the Saudi Arabia tax authorities have done this before. In ITB on the 5th of October, I covered 4 items of guidance on specific VAT topics, which had recently been issued in English language form by the authorities. As you would expect, there is some degree of overlap between those 4 items of guidance and the new general VAT guide. If you'd like to obtain a copy of this new general VAT guide, please go to our website or app. In addition, if you'd like to see the 4 earlier items of guidance, please go to our website or app and look for the 5th of October show. In the UAE, the tax authorities have issued unexpected guidance on the meaning of public transportation for VAT purposes. The guidance is relevant to the situation where a supplier sells a bus or train to be used to transport, for example, school children or employees or hotel guests. If the bus or train qualifies as a means of public transportation, the sale transaction is zero rated. If it does not, standard rate VAT applies. The new guidance takes the view that the term public transportation does not cover vehicles which are designed or are actually used to transport a specific category of individuals, such as school students, employees of a particular business, or hotel guests. Therefore, according to the guidance, sales of such vehicles are subject to standard rate VAT, not zero rated. I should emphasise that this guidance relates only to the sale of the vehicle. It has no impact on the supply of transportation services, which are zero rated if international or exempt if domestic. For a copy of this guidance, please go to our website or app. In Canada, the government has announced 3 tax measures in response to the US tax reform. The 3 tax measures all involve an acceleration of tax depreciation in regard to new investments in plant and machinery. According to the government's backgrounder document, the measures introduced will ensure that Canada maintains a tax advantage in attracting new investments. The average overall tax rate in Canada on new business investment, as measured by the marginal effective tax rate, METR, will fall from 17.0% to 13.8%. This will give businesses in Canada the lowest overall tax rate on new business investment in the G7, significantly lower than that of the United States. For a copy of this backgrounder document, please go to our website or app. Also in Canada, the federal court has allowed the tax authorities, which are undertaking a tax audit of a company, to obtain a copy of a tax due diligence report prepared by an accounting firm. In particular, the court denied the company's claim that the tax due diligence report was covered by legal professional privilege. For a copy of the decision, please go to our website or app. In Colombia, the government's tax reform bill is undergoing some amendments in Congress. So far, the main change concerns the standard rate for VAT. It will be kept at 19% instead of the originally proposed reductions. In the US, a court has held that for the purposes of the interest netting rule in regard to tax overpayments and tax underpayments, a US company and its foreign sales corporation subsidiary are not the same taxpayer. For a copy of the decision, please go to our website or app. And in Venezuela, the government has made a further increase in the tax rate on large financial transactions. Effective the 19th of November, the rate has been increased from 1% to 2%. The rate had been previously increased from 0.75% to 1% on the 1st of September. And now for this week's treaty developments. We've had 2 treaties signed and 1 treaty enter into force. And let me say that the Brazil-UAE treaty is particularly interesting for a number of reasons. It has quite a number of provisions adopted from the BEPS MLI, and the UAE is currently on Brazil's blacklist, although some folks expect it to be removed soon. Lucas de Lima Carvalho has written an excellent article on this treaty. For your copy, please go to our website or app. And speaking of the MLI, we've had quite a few more MLI synthesized texts published in the last week or so. Well, that's the way it is this Friday, the 23rd of November 2018. I'm Steve Towers. Have a great weekend.